On the program, we're talking about the three takeaways that investors can make of the market given what went on last week, particularly last Thursday with the 800-point drop in the Dow. Plus, we also want to give a couple of warnings. So before the segment, we were talking about the first two takeaways, if you will. Number one, volatility is in fact normal. And number two, volatility does not mean that the market is setting itself up to just fall 50%. Volatility is a normal part of the markets over time. Number three, volatility presents opportunity. And maybe it's an opportunity that you've sort of been struggling with, because if you look at the amount of savings that has happened even during the course of this pandemic, what's kind of unique is that the savings rate has increased dramatically. The amount of money sitting in cash has increased dramatically. And some of that, I suppose, is from less spending. But the reality is that there's also been a lot more money put into the system. So the numbers, when you look at it on a personal basis, are really kind of interesting. When you look at the savings rate for the month of April of this year, for example, reached a high of 33.5%. That was a personal savings rate. Again, some of that's because nobody was able to go out and spend any money because everything was closed and everybody was sheltered at their house. But if you compare that to the savings rate of the year before, April 2019, you'll find that that's about 7.5%. That's a pretty significant gap in terms of the savings rate and the portion of money that people are holding on to. And then if you look at just the sheer number of what that means in terms of cash, and this statistic looks just at money market accounts, what you'll find is there's been a 28% increase in the overall balance of money market accounts since the beginning of the year. So to put that into actual dollars, beginning of the year there was about $3.6 trillion sitting in money market funds. Today that number is about $4.6 trillion. So it's an extra $1 trillion, give or take, that is sitting there. And like many people, if you've got that cash sitting there and you're looking at it and you're saying, oh my goodness, that's making like nothing. I mean, this is just crazy that this money is sitting there and it's making zero because of how low the interest rates have been pushed down during the course of the pandemic. It really is impossible to get any level of return on cash or money market types of savings, particularly when you consider inflation normally runs at 2 or 3%, and then you have to pay taxes on whatever interest it is that you make. You're not getting ahead by just simply leaving it sitting in cash. So we say that volatility presents an opportunity because maybe you find yourself in that position where you've got more cash, you've got extra cash, and so you're looking at the return and saying, I don't necessarily need this much money just sitting in cash, but I'm concerned about the volatility of the market. Well, understand that volatility presents opportunity whereby you could take some portion of that money and add it into your investment accounts. Don't make it an all or nothing decision. I say to people all the time, don't make investing money an all or nothing decision. Make it a decision that you make incrementally along the way, where you're putting money in on a regular basis, that you're using volatility to your advantage, whereby if you see the market kind of trending down, that's a good opportunity to try and take some of that cash off the sidelines and invest it. So remember, make sure you're using volatility as a opportunity rather than just simply using it as an opportunity to further sort of dive underneath those covers, which you may very well be doing on a Labor Day weekend. Of course, we mentioned in the beginning of the show, we're away this weekend. We're still doing the show live because we do everything outside of the studio now. All of this post-pandemic, or not really post-pandemic, in the middle of the pandemic environment, we are doing the show through the magic of the internet, the computer, all this technology. When the folks at the studio brought over all of this stuff, I've got like a full bag of stuff that I have to carry around with me in order to do the show. And except for the fact that I forgot, because it's Labor Day weekend, I forgot a shirt and a tie, which normally I, kind of dress and be ready for the show. So we're very casual today. Also, not shaved too. So if you follow us on YouTube, you'll see that we're a lot more casual than we normally would be here on the program. But anyway, regardless, welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, and I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So those were the three takeaways for investors, right? Volatility is normal. Volatility it does not mean that the market's going to go down dramatically. Volatility presents opportunity. Now, we'll give you the two warnings, right? So if you're invested, you need to stay invested. That's warning number one. Don't jump in and out of the markets with dollars that you have invested. You're going to get that wrong. Ask anybody who got out of the market in March what the hardest part of that decision is. It's not the decision to get out of the market. That one is super, super easy. It's always easy because you're working off of emotion, you're making decisions based upon emotions, and ultimately you wind up simply taking and making a move that at the time makes you feel good, but then the much harder part of it is trying to figure out when to get back in. And that's the piece that people are really struggling with and trying to figure it out. So bottom line, if you are invested, you stay invested. And then number two, check your diversification. We've talked a lot about this in some programs this summer. The reality is that a lot of the market is structured or is performing based upon the performance of a handful of companies: Facebook, Amazon, Netflix, Google, Apple, Microsoft. Those small handful of companies are driving a lot of the performance. The latest numbers on it, just to give you some perspective on it, is those top 5 stocks that are all those tech, social media type or software types of companies. Those top 5 drive 40% of the performance of the NASDAQ. So just watch that, check that. I think that would be the warning that I would give to all investors, is to make sure that your diversification truly is diversification and you're not getting quite so heavy in those 5 companies that really are driving things pretty dramatically. So just watch out for that part in terms of your overall portfolio. So make sure you're doing the analysis, drilling down a little bit deeper in terms of what's the overall allocation, how much percentage of this particular company is in my portfolio, in order to make sure that you're not getting so concentrated on those companies that are taking a lion's share in terms of the performance. Because what happens is, then if something starts to deteriorate with those companies or with that sector, then you're going to be feeling that disproportionately in the value of your account. So some key takeaways and a couple of warnings there for investors to consider in light of what's going on in the market over the course of not just the past couple of days, but also really the past several months. So speaking of some things that have made some headlines of late, there are so many myths and so many misunderstandings of Social Security these days, and we thought we would take a moment in the program to talk a little bit about some of the more popular myths and ultimately sort of go through the process of giving some perspective, maybe not fully debunk some of those myths, but really go through the process of trying to give some perspective. And we've got 6 of them, if you will, and we teased at the beginning of the program, the 6 myths involving Social Security. So we're going to dig into that at great length in our next segment. So we'll take a break. When we come back, we're going to return here on Dollars and Cents and talk about the 6 myths about Social Security coming up next here on the program. This is Dollars and Cents with your host Joel Garris of Nelson Financial Planning on News Radio Orlando, along with 96.9 The Game.